Are you ready to pinpoint the best real estate markets of 2025? Imagine harnessing data on global economic trends, rental yields, and employment growth to make confident investments. In a world where the United Nations forecasts 2.8% global growth next year, stability is in short supply. Meanwhile, the rapid expansion of AI tech hubs has driven rents up 6% in places like San Francisco, more than double the rise in New York City. With so many shifting forces, where should you place your capital? Over the next 20 minutes, we will guide you through 5 top U.S. cities primed for real estate success in 2025. You will see clear metrics, side-by-side comparisons, and actionable steps to complete your due diligence. By the end, you'll know exactly where to look and how to proceed. Let's start with the big picture. In 2025, global economic growth is expected to hover around 2.8%. That modest pace signals a world of steady, subpar expansion. But behind that headline number, dramatic shifts are underway. The rise of smart cities, powered by prop tech and AI-driven infrastructure, is redefining where people want to live and work. Demand for suburban homes worldwide is set to grow by 25% as remote and hybrid work models shift preferences away from dense urban cores. At the same time, commercial office vacancies are rising, while co-working spaces adapt to new collaborative habits. Tech hubs remain magnets for talent. San Francisco's rents climbed 6% in the past year, more than twice New York City's increase, reflecting intense competition for housing near AI research centers. That trend highlights both opportunity and risk. High rent growth can drive strong returns for investors who buy early, but it also demands careful timing and liquidity planning. Meanwhile, emerging markets in the Sunbelt are capturing tech and manufacturing expansions alike. States like Texas, Arizona, and Georgia are winning big investments in electric vehicle plants, data centers, and semiconductor facilities. Major corporations from Apple to Hyundai are betting on these regions, fueling job creation and demand for housing. Affordability has become a cornerstone metric for savvy investors. Cities that balance growth with cost control offer a sweet spot of yield and stability. For properties to deliver real returns, investors must track rental yields closely. Urban centers in the Midwest and the Southeast are outperforming coastal markets, delivering double-digit gross rental yields thanks to lower entry prices and healthy renter demand. Commodity prices and supply chain resilience also play critical roles. Investors should monitor local regulations and tax incentives that can enhance net returns. In many states, favorable property tax structures and credits for sustainable building practices can improve cash flow substantially. Global interest rate trends will also shape real estate markets. After an extended period of elevated borrowing costs, central banks may begin cautious rate cuts if inflation shows persistent decline toward target levels. Lower mortgage rates could unlock further price appreciation and broaden buyer pools, but they also risk reigniting overheating in the most speculative segments. Diversification across property types, residential, industrial, and multifamily, can help balance risk, since each sector responds differently to macroeconomic shifts. Another key driver is demographic change. Millennials and Gen Z are entering prime homebuying years in record numbers, boosting demand for both ownership and rental units. Simultaneously, aging populations in certain regions may tilt the mix towards senior housing solutions, senior living communities, and healthcare-adjacent properties. Urban planners and investors should track zoning updates as municipalities adapt to these demographic realities. Local infrastructure spending on transit, green energy, and broadband often signals where governments expect future growth to concentrate. Sustainability is no longer optional. Properties featuring smart home automation, energy-efficient systems, and green certifications command premium rents and resale values. PropTech innovations, from AI-driven building management to blockchain-enabled title transfers, streamline operations and reduce overhead. As environmental, social, and governance considerations move to the forefront of capital allocation, properties that meet rigorous ESG standards stand to attract institutional and private investors alike. With this comprehensive view of global drivers in mind, we now turn our focus to the individual markets that promise the strongest blend of growth, yield, and affordability in 2025. Our first stop is Austin, Texas, a city redefining the limits of tech-driven expansion. Austin, Texas, leads our list with compelling metrics across every category. Home values in the capital of the Lone Star State are projected to grow by 9.7% in 2025. That outlook is fueled by a surge in tech job creation as companies like Apple, Tesla, and Oracle expand their campuses in the region. The unemployment rate remains below the national average, hovering around 3.5%, while median household income shows steady year-over-year gains. These fundamentals support both price appreciation and rental demand. On the rental side, Austin offers a gross rental yield that falls slightly below some Midwest markets, around 5 to 6%, but compensates with faster capital gains and population growth. Tens of thousands of new residents move to the city each year, drawn by the live music scene, outdoor amenities, and favorable tax environment. Local regulations have remained landlord-friendly, though recent ordinance updates require careful review. Texas imposes no state income tax, which enhances net yields significantly. Investors in Austin should watch specific neighborhoods like East Riverside, North Burnett, and Pflugerville. These submarkets show strong rent-to-price ratios and anticipate new transit infrastructure linking them to downtown. Purpose-built multifamily developments are gaining traction, especially near the University of Texas campus, where student housing continues to tighten. Institutional investors have already targeted this sector, driving competition, but also validating the underlying demand. Employment in Austin's tech sector is forecast to grow by 7% over the next 2 years, outpacing national averages. The city's Q4 2024 office vacancy rate sits at around 9%, reflecting new supply but also ongoing tenant demand. Investor surveys show growing interest in build-to-rent communities, a trend likely to continue as young professionals seek flexible leases and amenity-rich living. Furthermore, Austin's international connectivity via its expanding airport and highway infrastructure supports commerce and tourism alike. Short-term rental regulation remains favorable, making the city appealing to investors in vacation and executive housing markets. With its strong blend of fundamentals, growth outlook, and regulatory tailwinds, Austin stands out as a top-tier pick for real estate investors in 2025. Minihook, imagine capturing nearly 10% home value growth while enjoying landlord-friendly rules and no state income tax. Austin's winning formula makes it a must-watch market in 2025. Next, we move to Raleigh-Durham, North Carolina, an emerging tech powerhouse with affordability baked into its DNA. Raleigh-Durham, North Carolina, secures our second spot by combining a robust STEM ecosystem with affordability. Home price growth is expected at 8.4% in 2025, propelled by established institutions like Duke, UNC, and leading research parks. The region's STEM job market shows year-over-year employment increases of over 6%. Compared to other tech hubs, median home prices remain 25 to 30% lower, offering compelling entry points for investors. Gross rental yields average between 6 and 7% in key submarkets like Cary, Durham proper, and North Raleigh. Strong rental demand stems from a steady influx of graduate students, young professionals, and healthcare workers. The biotech and life sciences sectors are expanding rapidly, with new lab space breaking ground each quarter. Investors who focus on townhouse and condominium developments near transit corridors have reported particularly attractive cash-on-cash returns. Local regulations in Wake and Durham counties afford favorable conditions for landlords, though investor diligence is crucial. Short-term rental rules vary by municipality and may require specific permits. Property tax rates range from 0.8 to 1.1%, among the lowest in the Southeast. Additionally, state-level incentives target renewable energy projects and affordable housing developments, which can unlock tax credits and reduce net capital outlay. Neighborhoods like RTP, Research Triangle Park, offer unparalleled access to corporate campuses and research facilities. Apex and Holly Springs provide growing suburban alternatives with new schools, retail, and park space. With a strong blend of academic prestige, tech job growth, and diverse housing options, Raleigh-Durham offers a balanced risk-reward profile for 2025. Investors seeking diversification across property types will find opportunities in both residential and adaptive reuse industrial sites, as Wilmington research campuses repurpose older facilities. As you consider a shift from coastal markets, Raleigh-Durham's affordability and academic-driven growth become hard to ignore. Minihook. Imagine investing in a tech-driven region where home prices are still a quarter below Silicon Valley levels. Raleigh-Durham makes that possible. Next, we head southwest to Phoenix, Arizona. Phoenix, Arizona ranks third on our list, with an expected 7.1% home price growth in 2025. The city's manufacturing sector is booming, with a 14% increase in jobs forecasted, led by semiconductor and aerospace firms. This industrial expansion drives demand for worker housing and bolsters rental markets. Phoenix's affordability is striking. Median home prices run 35% lower than Los Angeles, yet rent growth tracks similarly upward. On the rental yield front, Phoenix offers gross returns of around 6 to 7%, depending on neighborhood. Suburbs like Chandler, Gilbert, and Peoria are hotspots, combining new residential developments with quality schools and amenities. Vacancy rates hover near 5%, tight enough to support rent increases, but balanced enough to allow for manageable tenant turnover. Arizona's property tax rates are favorable, averaging less than 1% of assessed value. Investors can also benefit from local rebates on energy-efficient upgrades and credits for historic property preservation in downtown Phoenix. These incentives can boost net yields significantly over a hold period. A notable trend is the migration of remote workers seeking warm winters and lower cost of living. The statewide adoption of broadband subsidies and expansion of co-working spaces have made Phoenix far more accessible to digital nomads and small businesses. Short-term rental platforms continue to thrive in tourist-friendly areas, though regulations vary by municipality. Employment growth in Phoenix's broader metro area is projected to surpass national averages. The city's unemployment rate fell to 3.8%, reflecting a healthy labor market. Investment surveys rank Phoenix among the top 5 cities for new multifamily starts, signaling developer confidence. As land is still relatively abundant, new suburban master plan communities incorporate sustainable design features and integrated mobility options, attracting families and professionals alike. For investors focused on build-to-rent, Phoenix offers strong pipeline potential. Research indicates that co-living and micro-unit projects are also gaining traction, catering to young professionals who prioritize access to entertainment and transit. With its strategic location and diverse economic base, Phoenix delivers a compelling combination of yield and growth. Minihook. Picture capitalizing on Arizona's manufacturing renaissance and outsized affordability. Phoenix stands at the intersection of industrial growth and residential opportunity. Next, we shift to the southeast with Atlanta, Georgia. Atlanta, Georgia stands as our 4th top city with an anticipated 6.8% increase in home values for 2025. Major developments like Hyundai's $5.5 billion electric vehicle plant in West Point, creating over 8,000 jobs, underscore the region's manufacturing momentum. Meanwhile, corporate relocations from Fortune 500 firms continue to bolster the metro area's white-collar workforce. Housing affordability remains a winning factor. Median home prices in Atlanta are roughly 20% below the national median, yet rents have climbed steadily, delivering gross yields between 5 and 6% in established suburbs. Neighborhoods such as Decatur, Kennesaw, and East Point offer strong rent-to-price ratios and access to MARTA transit lines, ensuring tenant appeal. The local government has introduced tax abatements for mixed-use developments, aiming to revitalize underutilized zones. Property tax rates average around 1.2%, but enterprise zone incentives can reduce this burden for larger projects that meet job creation thresholds. Investors should be mindful of new zoning regulations that promote urban infill and denser construction near transit corridors. Atlanta's film and entertainment industries are also surging, attracting creative talent and driving demand for short-term rentals. The city's Hartsfield-Jackson Airport ranks as one of the busiest globally, ensuring robust visitor traffic year-round. Job growth in the healthcare and logistics sectors has further diversified Atlanta's economic base. The region's unemployment rate hovers around 4.1%, maintaining pressure on rental occupancy rates. Some suburbs near Atlanta are witnessing early adoption of smart home integration, with utility management apps and IoT devices becoming selling points. These trends attract tech-savvy tenants willing to pay minor premiums for convenience. Additionally, public-private partnerships are funding new green spaces and pedestrian-friendly districts, increasing property attractiveness and long-term demand. Investors focusing on Class B multifamily assets report consistent occupancy above 95%. For those targeting single-family rentals, emerging suburbs offer ready-made communities with favorable covenants and homeowner association guidelines that protect property values. Atlanta's combination of economic diversity, infrastructural investment, and culturally rich neighborhoods make it an indispensable market for real estate investors in 2025. Minihook envision tapping into Georgia's EV revolution and steady rental growth under a warming southeast sun. Atlanta merges manufacturing strength with landlord-friendly policies. Next, we head to Nashville, Tennessee. Nashville, Tennessee completes our list with projected home value growth of 6.5% in 2025. Known as the Music City, Nashville's vibrant cultural scene drives tourism and short-term rental demand. The healthcare industry anchors the local economy, employing hundreds of thousands in hospitals, biotech, and research institutions. That stability supports both long-term leases and seasonal rentals. Gross rental yields in Nashville average around 6 to 7%, boosted by favorable short-term rental laws in the central districts. East Nashville, the Gulch, and the nation's neighborhoods combine nightlife, walkability, and new condominium developments. Vacancy rates are low, under 4%, reflecting strong occupancy. On the outskirts, suburbs like Hendersonville and Smyrna deliver slightly lower yields, but benefit from lower entry prices and family-oriented amenities. Tennessee's lack of state income tax enhances net returns on rental income and property appreciation. Property tax rates average around 0.7% of assessed value, among the lowest in the country. The state offers specific tax credits for film production and historic preservation, which can be leveraged by investors targeting older properties or adaptive reuse projects. Infrastructure spending on transit expansions and road improvements is scheduled to accelerate in the next 2 years, linking downtown to emerging exurbs. The city's growing reputation as a tech startup hub adds another dimension to its housing demand. Investors should track municipal planning meetings as rezoning initiatives may open new corridors for development. Nashville's population has grown nearly 20% in the last decade, outpacing the national average. That surge has pushed the metro area's labor force participation rate above 63%. Professional services firms and corporate headquarters in healthcare technology are relocating to the region, fueling office-to-residential conversions and creative redevelopment projects. Investors participating in build-to-rent communities report average lease durations extending over 18 months, a sign of tenant commitment. Co-living projects are also emerging, catering to young professionals drawn by lower cost of living compared with coastal cities. With its blend of cultural appeal, regulatory advantage, and sustained employment growth, Nashville stands out as a dynamic market for 2025. Mini-Hook. Picture owning a slice of Music City with strong yields, no state income tax, and laws favoring short-term rentals. Nashville strikes a chord for savvy investors. Now let's compare these cities side by side. With our 5 city profiles complete, let's move to a side-by-side comparison of key metrics. First, projected home value growth. Austin leads with 9.7%, followed by Raleigh-Durham at 8.4%, Phoenix at 7.1%, Atlanta at 6.8%, and Nashville at 6.5%. Next, gross rental yields. Among our 5 chosen cities, Raleigh-Durham and Phoenix offer the strongest returns at 6 to 7%, closely followed by Nashville. Austin and Atlanta deliver yields of around 5 to 6%, but compensate with higher appreciation rates. When we look at employment growth rates, Raleigh-Durham's STEM sector tops the list with over 6% growth. Austin's tech jobs are set to grow by 7% in the next 2 years. Phoenix's manufacturing sector expands at 14%, although its overall employment growth averages around 5%. Atlanta projects a 4% increase, and Nashville nearly 3%. In terms of affordability, Phoenix stands out with median home prices 35% below Los Angeles levels. Raleigh-Durham remains 25 to 30% lower than comparable tech hubs. Atlanta and Nashville house prices sit around 20% and 15% below the national median, respectively. Finally, median home prices show Austin at roughly $450,000, Raleigh-Durham at $350,000, and Phoenix and Atlanta both near $300,000, with Nashville around $310,000. Remember to factor in property taxes and local incentives when reviewing these numbers. Tennessee's low tax rates and film credits can tilt the net yield in Nashville's favor, while Texas's lack of state income tax boosts returns in Austin. In North Carolina, renewable energy incentives can improve project return profiles. Arizona's energy rebates reduce rehab costs, and Georgia's enterprise zone abatements lower carrying costs on larger developments. With these comparative insights in hand, let's turn to the essential due diligence steps that every investor must follow before making a commitment. Data and comparisons guide your decision, but a disciplined due diligence process ensures successful execution. We recommend 5 structured steps to vet any investment opportunity, whether you're targeting one of our highlighted cities or exploring alternate markets. Step 1. Market fundamentals analysis. Begin with a granular review of local economic indicators. Examine job growth forecasts, population trends, and major corporate announcements. Use sources like state labor departments, regional planning commissions, and local chambers of commerce. Verify that projected metrics, such as the 7% tech employment growth in Austin or the 14% manufacturing surge in Phoenix, align with recent policy developments and corporate commitments. Pay attention to near-term catalysts like infrastructure bond measures or enterprise zone expansions that may boost demand. Step 2. Submarket selection. Zoom in on neighborhoods and suburbs. Identify areas with strong rent-to-price ratios, upcoming transit projects, or zoning changes that support increased density. For example, East Riverside in Austin and RTP in North Carolina both benefit from proximity to job centers and planned light rail corridors. Consider factors such as school quality, crime statistics, walkability scores, and access to amenities. Mapping these variables against property price data uncovers undervalued pockets poised for growth. Step 3. Financial modeling and stress testing. Create a comprehensive pro forma model, including purchase price, financing terms, operating expenses, and realistic rental income projections. Stress test your assumptions by running scenarios with 5 to 10% higher vacancy rates or 100 basis points of interest rate increases. Incorporate local property tax rates and available incentives, such as solar upgrade rebates in Arizona or film production credits in Tennessee, to calculate net cash flow and internal rate of return under multiple scenarios. Step 4. Regulatory and title review. Engage local counsel to verify zoning rules, building codes, and any community association covenants that may impact property use. Confirm short-term rental regulations if you plan to include vacation units. For historical or adaptive reuse projects, ensure eligibility for preservation tax credits in Georgia or North Carolina. Conduct a thorough title search to uncover easements, liens, or pending assessments. Clean title and clear allowances for your intended use are essential to avoid costly delays. Step 5. Risk mitigation and exit strategy. Develop a robust risk management plan. Define the criteria for hold periods, exit cap rate targets, and refinancing triggers. Plan contingency actions for market downturns, such as converting units to multifamily or repositioning assets for alternative uses. Evaluate local liquidity conditions. Understand average days on market and buyer competition. Cultivate relationships with brokers, property managers, and local reinsurance providers to ensure operational resilience. Remember, due diligence is not a one-time task, but an ongoing process throughout the life cycle of your investment. Continually update your models with fresh market data and stay informed on policy shifts that affect your assets. This disciplined approach separates successful investors from the rest. As we conclude, let's revisit the promise we made at the outset, to guide you toward the best real estate markets of 2025 with data-driven clarity and actionable steps. We began by examining global economic trends, from the United Nations forecast of 2.8% growth to the AI-induced rent spikes in major tech hubs. We then profiled 5 top U.S. cities: Austin, Raleigh-Durham, Phoenix, Atlanta, and Nashville, each chosen for their unique blend of growth potential, rental yields, and affordability. Our side-by-side comparison illuminated the trade-offs. Austin's near 10% price growth leads the pack, while Phoenix and Raleigh-Durham offer balanced yields above 6% alongside lower entry costs. Atlanta and Nashville deliver moderate appreciation in markets bolstered by manufacturing, healthcare, and entertainment industries. We also highlighted how state-level incentives, no income tax in Texas and Tennessee, energy rebates in Arizona, and film credits in Georgia can tilt net returns to your advantage. Finally, we equipped you with a 5-step due diligence framework. From granular market analysis and submarket selection through rigorous financial modeling and regulatory review to risk mitigation and exit planning, you now have a clear roadmap for confident investment execution. Download our comprehensive market report to gain in-depth insights and actionable strategies.